Welcome back. And on this episode of the Wise Old Owl podcast, I have a good friend, Glen Silvestri from Sage Capital Partners, who's going to share with us some insight on the private equity investment market. Glen, thanks for joining us today. I really want to get into the nuts and bolts of what you do. And the reality is there are thousands of businesses across Canada and North America that don't have a succession plan. And 75% of small business entrepreneurs want to exit their business in the next 10 years. And this is where you come in. Can you share with our viewers what exactly you do and what type of opportunities come across your desk on a daily basis?
Yeah, so simple from the start. I mean, we're looking at small businesses. So things with 1 to 5 million of EBITDA. So that's our first kind of category killer. If you kind of are below that or way above that, we're probably not the right exit for you. But if you look at the entrepreneurial market generally, I always say, if you've built a business over a long period of time and you're a family, you kind of have several exits, right? So first exit is you might have a strategic that would buy you out. They're probably a better buyer than we are. I always say that honestly to people. The second exit is probably a private equity firm. And if you've got a private equity firm that can buy you and you've got a management team, you've probably got a better exit than, say, a search fund. And then you come down to a search fund. Well, what does a search fund do? Well, really what you're asking someone to do is come in and buy your business and provide you with a new CEO. So if you've gotten to the point in your career where you've built a business and you don't have a management team and you don't have a CEO to take over, that's where we come in. That obviously comes with a few, twists and belts to it, right? So when we come in, we're usually not the highest paying private equity firm because we're taking on two risks. One is you're walking out of the business as the owner, and that right away creates a risk. Number two is we're usually backing a brand new CEO who's probably never been in the industry. And so when we come in, we're usually asking you to take some money back. So in other words, hey, I got to leave something behind as the owner in order to de-risk my investment. So that might mean a vendor note. That might mean you roll over equity. That might mean escrows. That might mean all three of them, depending on what the business is. But typically speaking, we want to de-risk our investment a little bit.
And this whole concept regarding the search fund kind of originated out of Stanford University in California not too long ago.
No.
How long has this concept been in place, and how did you get into it? Because you were with some previous bigger investment funds. What appealed to you to be in this space?
Yeah, so the Stanford search funds basically started in the mid 80s, but that was just an inception. There was a couple of ideas and a couple of people who did it, backed by some professors. Really, in the early 2000s is when it kind of took off.
So it's in its infant stage.
It's still in its infant stage, and especially in Canada where you have, if you look at the statistics, 98% of our businesses are small businesses. They employ 65% of the people in Canada. We are a small business economy, so we're perfect for what search funds are. And so how did I get into the business? I saw an opportunity. I was at a private equity firm. I had invested in a couple of search funds. I started talking to the kids who actually ran them, and I was like, wow, they could use some help. And so when I left, I started helping them and I started putting in my own money, and I started realizing, wow, there's an opportunity here in Canada to actually create a fund around this. And look, out of the gate, it was very difficult. You're going to investors like you and explaining, hey, I'm going to invest in these 31-year-old people who have never had experience running a company, and I'm going to let them run the company, and I'm going to put millions of dollars behind it. Oh, and here's the kicker. They're not going to put in any money and they're going to get a ton of upside. So out of the gate, you look at it and you go, that's just crazy. But it works. The statistics say it works. The IRR has been really high, over 30% since 1984, and the multiples of capital have been about 3 times. So they're even better outcomes than either VC or traditional private equity. And that's what appealed to me. And then marry that up with a market that was really nascent in Canada. Nobody was really focusing on this market. It was all Americans coming into our market. And, I said, hey, we can create something here. And I got my partner, John, involved. And we said, look, if we add our two brains together, John's a lawyer, I'm an accountant, we can really drive the productivity of these businesses. We can help these searchers. We can really drive the growth and then hopefully drive the exit. And so far, the story's held together pretty well for us.
Having been part of it now for a number of years and going to some of these search seminars down at Stikeman's that Mario runs, it's really intriguing to see the excitement Americans have about the Canadian marketplace and how much opportunity exists up here. What is it exactly that appeals to you as a philosophy and a strategic investment? Is it people? Is it the industry? Is it the opportunity? What exactly do you try to hone in on?
Yeah, so it's all of the above, frankly speaking, but it all starts with a good searcher. I mean, a good searcher means he's got to be a good CEO. So if you think about our process of selecting a searcher that's going to run a company, typically speaking, we might invest $50,000, $60,000 in that person up front to just give them seed money to run the day-to-day operations of trying to find a business. But it's that interview process, I call it, over the next year and a half when they go looking for a business. And so how many businesses are you going to look at? What is it that you think about this business? How are you breaking it down? What do you think about the TAM, the customers, the industry, right? Listening to them and really understanding how they think about an industry and a business is the interview process that we go through in order to understand, is this the right person for this job?
For those folks that don't understand the space, you're investing in people to go out and search for businesses
Correct.
to buy. And there's a significant amount of time and effort in the vetting process to identify the searcher,
Yep.
right? Make sure they have the CV, the mindset, the understanding of you're going to have to put it all on the table. And it's going to be a struggle for the first 24, 48 months before you see an exit in most cases, right? Because usually the timeline's 3 to 5 years is what everybody kind of suggests. But it could be longer, it could be shorter. What is the formula? Like what is it that Glen looks for and John looks for in that candidate?
Yeah. So the biggest thing we look for are probably two things that we all break it down into. One is you can't teach smart. Is the person smart? Can they get their way around an investment thesis? And two is coachability. Can you coach them, right? They're going to have to ask questions. So if they don't ask questions, it probably means they're not coachable. And if you probe and push them on something and they say, I don't really want to do that, or they just ignore you, they're probably not coachable. It's almost like building a sports team, right? I mean, what do you look for in a good leader in a sports team? Probably leadership's the most overused term in the world, but in our world, it's like really, okay, are you smart and are you coachable? Well, in an athlete's world is he a great athlete or she? And are they coachable? Those are the two things that go into building a team. And so that's what we want as a team. We want a good CEO to be our star, and we're kind of the bench coaches. So we're sitting there and we're trying to every day help them grow this business, help them think about how they're going to exit eventually.
And they're looking at dozens and dozens of companies and, kicking them out for whatever reason. But there comes a point where you identify an opportunity. And can you talk a little bit about how difficult it is for that small business owner to let go, how they always overestimate their value, don't understand that there's got to be some costs that are built that they have to pull out because they don't have that person in that position. Like, it's an education of them too when you're going through that process, is it not?
It absolutely is. I mean, if you think about a business owner who's built a business over 30 years, and in some cases we bought 4 or 5 businesses that are multi-generational, emotion goes into it, right? So it's not just about numbers, it's about, will you take care of my baby, right? And so they have a view of value on their baby, which is typically probably well above market. The issue is they've gotten to the point where they probably don't have a succession plan. And the only succession plan they have is the person sitting in front of them who's 31 years old. And so a lot of it actually comes down to, can they see this person in their chair? Is this person the right person? They do a lot of soul searching actually, rather than number searching once they get down to it.
I remember you mentioning once to me in the past, you said, that searcher has to make that owner believe that they're going to look after their baby. So there's a bit of empathy and care and emotional massaging of that owner to let them believe that they can take it over and make them proud of their baby.
Absolutely.
Right?
Like, no doubt in line. I mean, I always say, if there's someone that has to make a hard business decision while you're buying the business and it requires a difficult conversation, probably best to let us do it. Because if you do it, you might damage that relationship. And post-closing, you need that relationship for 6, 9, 12 months to be able to transfer the knowledge over to that person. You don't want them upset at you. Let them be upset at us because that goes away and we're older, they're older, but you don't want the person being upset at the young guy who's coming in or the young gal who's coming in.
One of the things that's been very intriguing to me is the type of businesses you buy. They're not sexy. They're kind of fly under the radar, but they're needed. There's a need for the product or the service that they're selling. What's the most bizarre business that you've invested in and really said, wow, this is unbelievable?
Yeah, that's an easy one for me. It's like a slam dunk. Well, one of the first businesses we bought into is a plumbing camera snake company. I mean, they make those long snakes that go in and find, basically what's clogging up your drain, right? And so when we bought that business, I was looking at it and I'm like, there's a big guy in the market, named Rigid. Then there's a bunch of little guys who make these cameras, and then there's China. And I'm like, who really wants to be in that business? And so we bought the business. And I mean, the guy who ran it still runs it today. He has an MBA, he's an engineer. So he's got the business background, but he also likes to tinker. And we've actually grown that business 5-fold. It's probably worth over 10x what we bought it for. But it's a really odd business. It's a really niche-y business. And if you really think about it, I mean, it's sitting in poop, but it's awesome.
And having met them, they're interesting characters because they love what they do.
Absolutely. I mean, he lives it every day. He talks about his business like, wow, this is the most amazing thing in the world. And he even has monthly awards for the strangest thing you'll ever find in a pipe. And he thrives on it. Or he'll go in the back and tinker with the camera to figure out, is there a better way to build it? I mean, that's just his personality. And that's the perfect type of person you need for an industry and a product like that. So it couldn't have been a better marriage.
Now, you run a couple different funds. You have multiple funds. And some of the earlier funds got into the market when interest rates were at their record lows. We've seen rates elevate to tough levels for small business owners and a lot of these businesses. How are they adapting, and what type of strategies are you helping them with to deal with the additional cost and burdens of higher borrowing costs?
Yeah. So typically speaking, if you go back maybe 4 or 5 years, we probably were taking on a little bit more debt because literally the debt was being priced at somewhere around 3%. Now it's being priced at 7 to 8%. So we really want to watch what's called our FCCR, or fixed charge coverage. So how much are we paying each month out of our cash flow that goes directly to interest and amortization of that debt? So we'll probably take on a little bit less debt. What does that change for the owner manager? Well, typically speaking, they don't really want to go lower in terms of valuation because usually we're buying things at 4 to 5 times cash flow. So what do? Well, we say, well, we're not able to lever it as much. Probably means they need to take on a little bit more of a debt load for us. So they take back what's called a vendor note, and that vendor note ends up helping us to manage the return that we need at the end of the day to buy the business from them.
I always found it fascinating when you're looking at buying a company, how many lenders are at the table wanting to lend on this type of business. There seems to be a stronger appetite more than ever of lenders getting in this space. What's prompted that?
Well, I think a few things. One is we are, like I said before, we're a very small company economy. Like 65% of people work in a small business, and I define that as sub 100 employees. So if you look at the banks, in order for those banks to be in those big companies, they got to start where they're small. So a lot of them have realized that. Companies like BMO, for example, I mean, they are a small market lender who wants to grow into a mid-market lender and wants your company to grow into a large market lender. So they're very, very strategic, and they're very smart about starting with small businesses and letting them grow up. But they're not the only one. I mean, Scotia, RBC, they all compete for that type of business. They want that business, and it creates ancillary business for them as well. So example, the owner will sell his business. We will finance it. They want the owner's money that came out of the business, so they can investment management fees earned from that, et cetera, are going to be big for them. So they look at it as holistically a big transaction that they can get involved with in multiple facets.
I want to switch gears for a minute. and talk a little bit about the lack of succession opportunities within these families. You know, we've seen hundreds and hundreds of scenarios. What do you think the main reason kids today don't want to be in the family business?
As we see it, it's disinterest in getting in part of an industry in many cases. So, example, you get into importing of Asian food, right? There was a prime example. You had the second generation involved. Third generation had no need to be involved or didn't want to be involved. And it is because a lot of those kids will go to school and they'll get a profession or they'll get into IT, right? A lot of what we're doing in this country is moving towards a very technology-based economy. And so the next generation will say, well, I grew up, I went to a really good school, I probably ended up at a really good university, and now I want to use that to do something more quote unquote professional. So they tend to shy away from running those small businesses. Those are very hard businesses to run. You're in those businesses 9-10 hours a day. You know, you're dealing with a lot of employee issues. You're having to travel to China, to Thailand, et cetera, to find new opportunities to import food. So you understand it, right? It's a different thing.
How much do you think social media has played into that decision where younger folks just don't see the sexiness of their family business and want to chase the glitz and glamour of what else is out there, something more exciting and sexy, as I mentioned earlier?
Well, that's a great question because having a 17-year-old son now, I look at it and I say, it's that immediate gratification is very, very important to them. So the hard work, I don't want to make fun of a generation because then I sound old, but the hard work is a different thing for them. They value much more lifestyle and they value much less money. So if you rewind to when maybe our generation was growing up, but more importantly, I think our parents who came here as immigrants and those parents who, in cases of our business came from Asia as immigrants, their only opportunity was to go to work. They probably had small families, so they had to work hard to make money. This newer generation, there's a lot of money coming down the pike being passed down. I don't think they necessarily have to do what we had to do or what maybe our parents had to do in order to make ends meet. So it's changed for sure.
Yeah. You can definitely see it. Like there's just disinterest in the boring type businesses, right? But when you look at your portfolio of businesses, we're seeing a slowdown in the economy. Disposable income's down in households across the country. Are you seeing a trend amongst the businesses on how they're performing in the current environment? Like how are you dealing with these searchers who are now running these businesses and they're probably seeing all this for the first time? What's the day-to-day issues that you're seeing today?
So what you just hit on is very important. Having a searcher matched up with someone who's actually, lived through 2 business cycles is important, right? Showing them, hey, this is not going to be, up and to the right all the time. You've got to think your way through it. So what are we seeing in our portfolio? Where you're seeing government-sponsored money in the market. Example, HVAC. The last couple of years, there's been a lot of government-sponsored programs. Those have really slowed down, which has slowed down the market. But then you layer on top of that, people who need new furnaces and new air conditioners, something I didn't know, a lot of them finance it.
Yeah.
And so when they finance it, they used to be paying literally 3%, 24, 36 months ago. Now they're looking at paying 12%. That's what a loan is on a chattel. And so there's, hey,
payments going up.
Yeah, maybe I need a new furnace, but I think, can you repair it? Can we get it for another 2 years? Whereas if you go back, especially during COVID, people would say, just put in a new one. Why? There was enough money around. People weren't traveling. People weren't going to work. So there was more money around and interest rates were at 2%. So people were replacing it. So that certainly has affected the market. Now, on the flip side, I will say one of our investments is in enriched education. And we thought as the market got tighter, maybe we'd see parents pull back a little bit. But it's been completely the opposite of what we expected. In fact, parents have said, I want more education for my kids. They missed out for 2 years. So they're actually seeking out different programs for their children. So that disposable income is going towards their kids' education rather than maybe a vacation.
Yeah. When you're dealing with investors, you just can't take any investor. There's a process and a type of investor that you could deal with. Can you talk a little bit about the accredited investor profile? And this isn't for everybody, right? This is for a specific type of investor who has a risk tolerance that can withstand a total loss, really.
Yes.
So how do you approach an investor? How do you find your investors? How do you vet them?
Yeah. So
you don't take anybody.
We don't take anybody. Usually the investors we started with were all investors we knew. So they were, I'll call them ultra high net worth is what we started with. And then we got down to what I'll call high net worth. So most of them are people we know or friends of people we know. And how do we vet them? We literally walk through a KYC with them and know your client and understand where their assets are, how much money they make, and can they afford to lose it.
So very similar to the
mortgage industry, exactly.
Yeah, they have to be accredited. They got to make sure they understand they could lose everything.
Yeah, I would say to you, in our case, we're probably a notch above the MIC in terms of risk that you're taking on. But that's why a portfolio is very important. A lot of people want to buy into small businesses, and they'll say, "Well, I can go do what you do. I'll buy into that camera business that we were talking about." Well, A, you got to get that opportunity. And B, if that's the only one you do and it's the one that goes sideways, you're in trouble because you're going to lose your money. Whereas if you buy a portfolio of 12, the math says 2 are going to go sideways on you. 2 actually might go bankrupt, but the other 10 should do well for you. So as a portfolio, you're going to do really well. And so that's why I tell people, don't go looking to do these on a one-off basis. Actually, if you're going to do it, pool it. Pooling is very important, just like it is in the MIC industry.
You basically spread the risk.
Yep.
All right. It's more like a mutual fund. Would probably be the best example that someone could kind of relate to. Now, the last part of the exercise is the exit. You have to sell these things or you got to find a buyer. How difficult is that process? Or is there a pool of mid-market investors that want these businesses that have now been turned into something more valuable because your whole game plan is to increase revenue, increase EBITDA to a level that they're now attractive to be purchased? How's that process and how does that work? Is that something that there's a whole group of people waiting on the sidelines for these businesses to mature and take on and kind of tuck into a conglomerate type investment? Like, how does that all work?
So there's probably 3 things that we do because we're very active in our portfolios in terms of looking for exits. The first one is we are always looking for who's the big guy in the industry and what are they doing and are they acquiring? So Home Turf, prime example. There was 2 big acquirers in the industry. They were consolidating the industry. John, my partner, and I sat down and we said, let's reach out to them. Let's tell them that, hey, we exist, because they don't know we exist. So that's one way, is making yourself very visible that you're out there. And secondly, to that point, if you're owned by private equity, they know you're going to exit. So those are kind of the first things we do. The second thing we do is we try and make ourselves visible to investment bankers. And so there are some really, really good mid-market investment bankers. And primarily we try and use US investment bankers because they definitely have a bigger scape of the amount of people that are out there. They actually scour the earth to find the right buyer. So in the case of Voxco, really good asset, they scoured the earth to find the right buyer for that asset. Something, not to put down my Canadian brethren, but I don't think they would have had the reach to do. And then the last piece is we actually do keep in touch with a lot of private equity firms who say to us, hey, what do you got on your portfolio? Let me see it. I want to know what's there, right? Because they know ultimately we're going to exit. And many of those investments will serve as one of 2 things. Either A, a platform for something they want to build much bigger because they know we don't have the money, or B, it's an add-on to what they already have. And so we do a lot of reach outs to PE firms, and we actually encourage the searchers, go to the conference for your particular industry. Don't shy away from meeting people and tell them, oh, it's a private company. You actually are a private public company. You need to sell. So make sure people know you're out there and make sure that they know you're going to be for sale at some point. And if they want to come early, we're always willing to listen.
Glen, I've really enjoyed my experience in your funds. It's a learning curve, but at the end of the day, it's all about people. It's all about finding the right people to match up with companies and personalities that have the ability to take something from X and turn it into X plus Y. And it sounds like that's your day-to-day job, is managing the people. You're in touch with these folks on a daily basis, weekly basis?
Daily, weekly. We only have one guy that we probably touch base with monthly because he does such a good job that we don't have to.
You don't have to.
But I can tell you, I'll give you a perfect example. Today, I sit on 6 boards. I talked to 4 of my CEOs today. Tomorrow, I'm going to meet with one of them. So that's the 5th. So every week there's some kind of touch point, and usually it's every 2 days. There's some kind of touch point with them. And that's a little bit different than, the other investors that might invest in search. And I'm not putting them down. They just have a very different model. They very much put it down to, let's have a board meeting. And then if you need anything, call me. Whereas let's have a board meeting. And when I need something, I will call you, or I will bug you, or I'll ask you questions, or I'll say, have you thought of this or thought of that? And that's a different mentality. It's a very much a private equity mentality versus a search investment mentality. And I'm not saying one is better than the other. I'm just saying that's what we think we bring to the table. So we're going to continue doing it. And so far, I think, example Home Turf, example Hawthorne, example Thai Foods, I think it's paid dividends for us to be very active in our portfolio.
Got one last question for you. How did Matt withstand the winter in Red Deer, Alberta? Because you had to move out there.
I personally always say, I hope searchers will tell me they'll move anywhere in the world, because I definitely won't.
Glen, thanks so much for this informative chat. It brings light into an industry which I think is going to continue to grow. And I wish you luck and keep on doing what you're doing.
Thank you.
Doing a
Thank
great
you
job.
for all your support investing with us.
Thanks.
Take care.